Hello and good afternoon. My name is Amy Maxwell. I'm from Citywire and I'll be presenting today's broadcast. Today, we'll be joined by our guest, Praveen Kumar, manager of the Baillie Gifford Shin Nippon Investment Trust. He'll be providing us with some fresh insight into what's really happening on the ground in Japan. Now, all COVID restrictions have been lifted. There's plenty to update on the companies he's already invested in, as well as some new and exciting themes he's pursuing. We'll also touch upon valuations and the unique environment Praveen is witnessing right now. So lots to talk about. Welcome, Praveen. Thank you very much for joining me.
Hi, Amy. Thanks for having me.
So you're just back from your second trip to Japan in 6 months. So what was it like to be on the ground after a pandemic-induced hiatus?
Yes, that's right. So I was in Japan for 2 weeks in November last year, and I was in Japan again just a couple of weeks ago. So in total, in the span of 6 months, I've spent 3 weeks. And over the course of these 3 weeks, I met no less than 54 companies. So quite a packed schedule. But it was interesting to kind of draw some high-level observations from these meetings. So the companies I was seeing were from a range of sectors. And I would draw kind of 3 broad observations from my sort of time spent in Japan meeting with these 50-odd companies. The first one, obviously, was, as you mentioned in your introduction, all COVID restrictions have been dropped. Japan is open for business. It's open for tourism. It was interesting. I saw quite a lot of foreign tourists, and by foreign, I mean non-Chinese. So there's still the recovery in Chinese tourism is taking a bit of time. So we're still not seeing the floods of Chinese tourists that we used to see in the not sort of too long ago. But that's obviously a big opportunity for a number of our holdings. And the second observation I would make is speaking with the management teams of the companies, and I was meeting majority of the companies with the presidents of these companies. The overall tone seemed to be one of cautious optimism. I certainly didn't see companies being worried about end demand or worried about, they acknowledged some of the challenges in terms of geopolitics and what's been happening with central banks and interest rates. But across the piece, there was quite a strong sense of optimism. Companies were busy adding capacity. In a lot of cases, there were companies complaining that the demand was just so strong for their products that they were just not able to keep up with the demand. And run through a few examples of that. So the overall sentiment I got was one where companies were generally cautiously optimistic in terms of the medium-term demand. And the final point I thought worth making, which again is a slight difference from what we've heard and seen, or at least what I've heard and seen from Japanese companies in a long time, is this acknowledgement that the cost of capital has actually gone up because interest rates go up. So gone are the days where you could, avail of cheap money and basically engage in profitless growth, almost. There was a very strong acknowledgement that the companies do need to show that their business model works. They do need to start making a reasonably sustainable level of profits, whilst not compromising on the growth. So I think that last bit is perhaps the most exciting insight for me in terms of companies being able to show really rapid growth, but at the same time, grow their profits as well.
Okay, so it's a really a sort of changed dynamic in the few years in which you've been away. So in terms of how the visits have shaped your investment thinking for your own portfolio, what are some of the companies? Can you give us a taster as to what some of the conversations you were having with current portfolio holdings and some updates there?
Yes, so there are a number of trends that are sort of happening behind the scenes in Japan, and these, because they tend to be quite sort of slow burn type trends, they don't really get that much airtime in Western press. And frankly, they are a bit boring if you want to write an exciting article. So an article titled, the Nikkei hits sort of, an all-time high at 33,000 or whatever, probably get a lot more hits than an article saying people's working habits have changed in Japan. There's a lot more acceptance of working remotely. And that is exactly what we are seeing. A lot of companies that I were meeting, hardly sort of 10% of the staff were in the office at the time.
But I mean, just to emphasize though, this is a huge cultural shift for Japan. So it really, they should be huge headlines, really, in terms of the impacts it's having on sort of culture.
It is. I think it kind of hints at quite a significant change in mindset of corporate Japan, where previously, you would be required as an employee to come into work every day, post the pandemic and, report to your bosses. So very, very traditional mindset. And these couple of visits in the last 6 months, and just to be clear, this is not just a sentiment that I saw with some of the more younger dynamic companies. So I met a range of traditional manufacturers as well. Some of them were like 70, 80-year-old companies. So even there was quite willing acceptance that people's expectations have changed, employees' expectations have changed, and they were much more open to this idea of flexible working. And what this change in mindset is done is it's created a huge opportunity for companies like Citywire, which is a current holding in Shin Nippon. And this is a company that buys really old houses, typically 30, 35 years old, renovates them to a high standard, and sells it to first-time buyers, typically a family of 3 where both the husband and wife are working. And now what we're seeing is, because of this work from home sort of option that a lot of people are getting, they're looking for slightly larger homes, maybe homes with a bit of a study as well. And a lot of people are actually moving outside of Tokyo because it's very difficult to get those types of houses in Tokyo that are affordable. So
of course, because Tokyo is known for space saving. So there's another big shift going on there as well.
Exactly. So you have these kind of box-sized apartments that are priced at an absolutely ridiculous level. So we're seeing, I wouldn't say a massive shift, but there's a decent chunk of population that's gradually moving to the suburbs of Tokyo. And, that's where companies like Citywire actually operates. And they're seeing quite strong demand for this type of cohort that's looking for a bit more space, but more affordable. And it's actually cheaper to buy a Citywire house than to actually rent in Tokyo. So it's a win-win situation for, those types of families that are renting in Tokyo and want their own place with a bit of space to work from home.
You might see some change in the demographics and the birth rate, and it's known to having an aging population. Maybe this is a shifting point.
That's a very interesting point you make, Amy, because that's exactly my initial thought was, where obviously the government is doing possibly everything it can to try and boost the birth rate, because obviously, we've known for years that Japan has had terrible demographics. But people have not really taken it that seriously. They've just, kicked it in the long grass and, just taken the view that this is a problem for another day. That another day has come right now. And the government is basically coming up with a whole raft of measures, trying to throw money at the problem, trying to encourage companies, encourage, people. And I think small things like these, as you rightly said, could actually be, a small catalyst in trying to kind of, kickstart the whole birth rate sort of resurgence. Now, obviously, it takes quite a bit of time, so we'll have to wait and see. But this is definitely a step in the right direction, I would say.
Fantastic news. Okay. And I understand there's also another theme you picked up during your visit was, you touched upon it earlier on in our conversation, the inbound tourism, the return on it. GMO Financial Gate. Do you want to talk to us a little bit about it? It's a payment specialist. Do you want to talk to us about how that's getting on and why it's still kind of interesting to you in the portfolio?
Yes, so GMO Financial Gate is probably one of the stocks that I'm most excited about. So we've all known about online payments, e-commerce, and one of our companies that we've owned it for over 10 years, is a company called GMO Payment Gateway. So it's a different company. That company mainly does gateway services for online payments. Now, GMO Financial Gate, it's actually a subsidiary of the Payment Gate. So, apologies if it sounds confusing. But GMO Financial Gate, it does offline payments. And by that, what I mean is, if you go to say a John Lewis store and you buy an item and you pay using a credit card, so that's like an offline transaction. And typically you would either go through a Visa or a MasterCard or an American Express network, depending on which card you have. What GMO Financial Gate have built is a completely new network that bypasses all these 3 networks.
Oh,
It's on average about 20 to 30% cheaper. As you know, there's been a lot of hue and cry, both in Europe and the UK, about, credit card charges and how these companies are abusing their monopolistic position. So
yeah.
this company has built a completely new, really fast, low-cost network that's bypassing the traditional Visa MasterCard network. And interestingly, what they've also done is, so they sell you a terminal which accepts over 30 different types of payments like QR codes, credit cards, debit cards, etc. But also for the merchant, they can download apps on that terminal, apps that help the merchant with their business. So things like if you want to link the point of sale terminal with your inventory, so you can download an app for that. If you want to look at the time management, so your employees swiping in, swiping out, how many hours people are putting in, you can download an app for that. So all these apps, majority of them are developed by third-party developers. So it's almost a bit like an app store, Apple App Store type ecosystem. So really interesting business model. And this company has been growing like an absolute weed, well over 40-50% in terms of sales.
And so this insurgent, do you think it has potential to go beyond Japan, or is it very much kind of a Japanese story?
I think for GMO Financial Gate in particular, just the scale of the opportunity in Japan is so massive. If you think about the offline retail, that's easily worth, a few trillion yen. And GMO Financial Gate is only just starting. It's got, a single digit billion yen kind of sales, obviously growing quite rapidly. So I would almost be tempted to say that, overseas is likely to be a distraction for this company, simply because the opportunity in Japan itself is so massive. And interestingly, no company has attempted what GMO Financial Gate is attempting to do, simply because Visa, MasterCard, American Express, they've had such a stranglehold on the market that companies have just felt it's not worth their while trying to, take share from these big US companies. But this one company is trying to do exactly that. So I think the opportunity in Japan itself is quite massive.
Fantastic. Okay. And so far we've got sort of a change in culture in terms of living, a change in culture in terms of a disruptor from the traditional ecosystem, retail consumer ecosystem. Now, did the trip spur any new ideas in terms of, were there some, obviously you can't name names if you haven't invested yet, but in terms of the themes in which you picked up on, is there some exciting information you could impart there?
Yes. So the most recent trip, so I was there for 5 days. And in 5 days, I came back with 4 new ideas, which is,
oh, wow.
I think a pretty significant return on investment, I would say. When I say 4 ideas, I just don't mean ideas where, I would have to do a bit more work. These are 4 solid new ideas. And it's quite interesting how different these 4 ideas are. So one of them is an artificial intelligence company. Now, in Japan, there are a whole host of artificial intelligence companies. We've spoken to at least 5 or 10 of them in the last 3-4 years. We know the whole area of artificial intelligence can be hugely disruptive, especially in a very, very traditionally minded, very slow-moving economy like Japan. Unfortunately, we've not found any interesting investment simply because the artificial intelligence companies or the AI companies we've spoken to so far, they've not really had a robust revenue model. It's all been project-based. So a client would come to you and say, can you solve this problem for me? And the company would develop an AI model software and give it to them. And that's it. So there's no concept of a recurring revenue or anything like that. Now, this one company that we met, actually, it's run by a husband and wife duo from Taiwan. Only about 20% of the staff are Japanese. The rest are all Taiwanese from Southeast Asia. They've got quite a few, Western employees as well. Very international business already. Only about 30% of sales come from Japan, and it's growing quite rapidly. And what they've done differently is their AI software, it helps retailers and other vendors to improve the customer targeting abilities. So basically trying to increase the lifetime value of customers, helping these retailers find out who are the customers they should be targeting. Obviously, all of this is done with the consent of the end user. And their software very cleverly works out, if you target this person with X% discount offer, they're surely going to buy it, for example. So really very precise kind of agents they're targeting. And their model is based on the success of their clients. They don't charge a fixed fee. So they make money only if their clients make money, which I think is quite an interesting way of even validating a business model. And their sales are growing at about 30%. They have over a 90% retention rate. That means, 9 out of 10 customers keep using their software every single year. So really...
So I imagine at that level of intelligence is probably invaluable for many retailers to tinker with their offering and to target, to know that they're targeting the right people.
Exactly. I mean, I'll give you a very simple example. So if, let's say, you put a few things in your shopping basket, and before you press buy, you got to run off on an urgent errand, and you come back, you forget about it. Now, what this company allows that retailer to do is basically give you a message on your phone or on your tablet saying, "Hi, Amy, there are these things in your basket. Would you still be interested? Or, and by the way, we can give you 10% off." So, it's kind of a really granular level of targeting. And for some, it might seem a bit scary as well, but it's obviously, it's all done with the consent of the customer and at a very high...
The double pincer with the discount.
Exactly. So, very interesting. And it's actually, I almost think it's a Taiwanese company, headquartered in, they've got headquartered in Tokyo, but for all intents and purposes, it seems like a Taiwanese company that happens to be listed in Japan. So very interesting.
Okay. And I believe that there's, keeping in the area of sort of technology, the semiconductor space is another area where you found some interesting insight and some companies of note.
Yes, and it's quite topical because, as some of your readers may have seen today, one of the largest US semiconductor companies called NVIDIA had some extremely good results, and most semiconductor names are pretty strong on the back of those results. But broadly speaking, I think over the years, one very significant shift that's been missed by most people is Japanese manufacturers have moved away from making these big, visible sort of products like, the Sonys of the world, Hitachis of the world, the Toyotas of the world. And over the years, they've established quite strong, really critical positions in large, systemically important supply chains like semiconductors. And these are very small companies providing very mission critical kit, without which the whole supply chain would basically collapse. And I'll give you an example. So one of the companies that I saw and, quite interested is, it basically makes these huge metal tanks that are lined with a special sort of chemical. And these tanks are used to store all the gases that are used in the semiconductor manufacturing process. There are a number of gases that are used for different purposes, and these tanks are used to store them. And because these gases are so toxic, hazardous, and corrosive, you need the tanks to be really sort of almost like bulletproof. And that's what the lining actually achieves. It keeps everything absolutely sealed shut. And this company is one of 3 manufacturers globally of these tanks. And it's about, 5 to 10 times larger than the other 2 players. And it is the only supplier of these tanks to TSMC, so, the big foundry based in Taiwan Semiconductor Manufacturing Corporation. So, and not a lot of people, even in Japan, have heard of this company. So it's quite interesting. Wow. There are numerous examples like this company where you look at them and say they've got such an important position in the supply chain, without which, you really can't see the whole thing working.
And the ownership of these companies, are they family owned, or they seem to be quite small under the radar companies? But how is it to get in to speak to them, and how is the kind of corporate structure of those in terms of investment?
Yeah, I think the majority of them do tend to be owned by families, and the founding families tend to have reasonably large stakes. You also get a few manufacturing businesses where the family have perhaps exited a long time ago, and now it's kind of run by a professional management team. So this tank company is sort of an example of the latter, I suppose. But what's interesting is, for a lot of these companies, that doesn't tend to be the starting point. They would have started making something completely different. It's just that over the years, and this is a 70-plus-year-old company, this tank manufacturer, and over the years, they would have built enough expertise and knowledge in those specific niches that they're then able to use that library of skills and suddenly come up with a killer product that's applicable to a completely different industry. So this tank manufacturer, it didn't start out as a manufacturer of tanks. It started out making seals that go into containers that are used in, factories and, petrochemical plants. And that sealing technology, they got so good at it that then they saw the semiconductor industry that was using these really toxic gases. And then they came up with this idea, why don't we, use our sealing technology and see if we can apply that to the semiconductor industry. We've seen so many examples of companies that are able to do that. It's
so that traditional kind of, that reputation Japan has as full manufacturing and precision manufacturing is still there. It's, it hasn't lost its way, which many people would say so, but it's under the radar, as you say, producing mission critical equipment for really, really important industries.
I mean, this phrase of, that's used most of the time in Japan, sort of in terms of the lost decade, whatever. Actually, I think that gets a lot of airtime. And if you see what's happened in the last sort of whatever decade that this lost decade is referring to, the reality is actually quite different. Yes, there wasn't that level of growth in the economy per se, but the economy is different from the stock market. I think that's an important distinction. And what we've seen companies achieve in that sort of so-called lost decade is just a relentless focus on getting brutally cost competitive, building more and more of these library of technologies. And in the last kind of 10, 15 years, what we've seen is literally an emergence of these businesses using those technologies they built over the years to suddenly come with a product that's, become the go-to product in quite important global supply chains, which is why in this whole talk about geopolitics and things, Japan is such a crucial part of that conversation, simply because you have this entire army of equipment suppliers without which, as I said, the supply chain wouldn't work.
And it's an interesting kind of dynamic in the growth stocks kind of globally have struggled so much that this almost feels like a back door to that growth story without potentially so much volatility.
Yeah, that's right. I think what's happened is there's been a wholesale sell-off of anything with the word G in it. So anything that's related to growth. And people have not stopped to actually, take a step back and to actually look at what the business is doing. And I'll give you an example. One of the stocks we own in the portfolio is a company called GA Technologies, which is, an online real estate platform that's looking to disrupt the traditional high street type real estate model. And that is a business that is only about 8 to 9 years old, and it's already got to a sales of over 100 billion yen, which is quite remarkable for such a young company, and it is making profits. And based on historic growth forecasts and sort of the next year's forecast, it's maintaining a very fast pace of growth. But you look at the rating on the company, it's on a price to sales or price to earnings, it's trading as if it was an ex-growth company. So there are these extreme disconnects that we're seeing right across the portfolio, across different sectors, which is making me, quite enthusiastic, to be honest, at the moment.
It's been kind of reported extensively in the last year that, this idea of overseas investors coming back to Japan. So this person here has a question that says, what is going on the small cap space, in particular with overseas investors?
Yeah, so I think there's obviously been a lot of headlines in the FT, etc., about foreigners rushing in, and certainly we're seeing quite a lot of interest in Japanese equities. But for us, sitting here and engaged in investing in high growth businesses, it actually doesn't feel like that. And I'll explain the reason for that. The reason for that is because a lot of the foreigner overseas interest that we've seen, it's largely concentrated on stocks that are not really geared for growth. So the large part of the interest has been on companies where there's some change in terms of corporate governance, where shareholder returns are perhaps, there's a change in view in terms of shareholder returns, dividends, share buybacks. So it's really that segment, and it's a pretty large segment, to be fair. It's that segment of, somewhat old style Japanese companies that seem to be having a change of heart that are seeing quite a lot of interest. We've not yet seen the same level of interest kind of trickle down into the real sort of growth companies, the businesses of tomorrow, the really kind of dynamic businesses. And I almost think it's a matter of time, because with the former group of group of companies, these are companies that are just looking to survive, not looking to grow. So I'm pretty sure the interest in those companies is likely to wane. And that's when you get this sort of trickle down effect where people start looking at some of the more dynamic growth businesses that are expanding globally, exposed to some of these long-term structural trends like EVs or semiconductors, that will start looking a lot more interesting for overseas investors. So that's what I suspect will happen in due course.
Okay, thank you. I've got another question here. What's the percentage indirect exposure of the portfolio to China? So I would say there's quite a lot of geopolitics to touch upon there as well, which maybe you could elaborate on.
Yeah, so we don't really tend to calculate sort of the exact percentages in terms of the China exposure. Obviously, we do have quite a few manufacturing businesses in areas like factory automation, semiconductors as well, that have a decent level of sales in China, for instance. Again, it's quite difficult to calculate these percentages precisely, simply because quite often companies will classify sales quite differently. So to give you an example, you have numerous Japanese manufacturers where the manufacturing happens in Japan, but the product is shipped to China, but the sales are recorded as Japanese sales, if you see what I mean.
Yeah.
Sometimes you can get quite sort of confusing, not like for like numbers. But I would say, in terms of our direct exposure to China, it would mostly be, parts of the niche manufacturers as one of the thematic buckets that we classify the portfolio. So we would have some exposure there. In terms of global brands as well, there are a couple of stocks that have a reasonable business in China. But I think overall, a lot of these businesses, they're just continuing to, perform as usual. Certainly speaking of these companies, we've not seen or heard anything to suggest that the Chinese businesses are being disrupted. And it also helps to be kind of, not really the top tier in terms of the big, Toyotas of the world. It helps if you're kind of, under the radar. You're not really seen as something that's, too systemic or, easy to attack in some ways. So overall, we remain fairly comfortable in terms of a direct kind of China exposure.
Okay. Do you want to touch upon as well the geopolitical situation? I mentioned with US and China hostilities, and again the kind of Russia and Ukraine situation. There is significant impacts on supply chains, and for which the mechanics and some of the companies you've spoken about are integral to. So, could you just have a brief overview of how those tensions could impact the portfolio?
Yes, so this is definitely an issue that we just can't ignore, saying that it'll kind of go away with time. Japan sort of unfortunately tends to find itself squeezed between two great sort of superpowers. So at one end, obviously, in terms of the whole culture, the democratic system, the long-standing relationships with the US, so Japan wants to be closely aligned with the US. But when it comes to more pragmatic sort of concerns like, business and sort of the corporate sector, obviously China is a very, very important trading partner. That are quite, in aggregate, the Japanese exposure to China in terms of sales is reasonably high. So it's quite a delicate balancing act that the Japanese have, really mastered over the years. Because if you can imagine, this is something that's not just come up all of a sudden. You've always had the US-China tension, they flared up from time to time. But Japan has so far been quite masterful at kind of navigating, the middle path, not sort of getting on the wrong side of China, but at the same time taking a stand on what they see is the right thing and supporting the US. But having said that, a few companies, especially within the semiconductor space, because I think that's seen as quite an important systemic critical sort of industry, a few companies, from what they were saying, there is a sense that they need to somewhat diversify away from China. And well, diversify, I suppose, is not the right term. I suppose de-risking is the right term. So to give you an example of what that means in practice is some of the companies are now looking at adding the new production, incremental new production in the US. In fact, some of them are even bringing production back to Japan, which is fantastic news, for the local suppliers, for all these small cap suppliers. So we are seeing a few moves of that sort, but obviously I'm not saying that they're completely abandoning their China manufacturing or they're not investing in that at all. So that's continuing to happen. But at the margin, we are seeing tentative steps of just trying to de-risk some of the China exposure. That's where we are at the moment.
Okay. We've got a question here in regards to the metrics you're using. I wanted to know what metrics you're watching or which kind of feedback from management are you counting on to assess if these companies will become profitable in the near future? And we've had a similar question that maybe you could answer at the same time. It's in relation to what's the percentage, what percentage of your portfolio is invested in companies which are currently unprofitable? So I suppose it's a question about the how do you balance the opportunities and who's gonna win out, and who do you back and who do you drop at what point?
So the percentage of the portfolio that's in loss-making businesses, now it depends on how would you define loss-making business. So I almost think of it in two ways. The first category would be businesses that have been making losses for a number of years, let's say 5 to 10 years, for example, so consistent perennial loss makers. The other category would be businesses that have had a one-off issue, maybe a big impairment or a write-down because of which in a specific year they make a loss, but they've not been loss-making on an ongoing basis. So that's the second category. In terms of the first category, I would say only about 1 to 2% of the portfolio would be those types of stocks that have been making losses every single year. But there are specific issues as cases as to why they've been making losses. And I'm actually positive that they'll soon turn profitable. So that's kind of the first category, is sort of 1 to 2%. The second category of companies where, because of a one-off issue, they've expected to make a loss in a single year, that I would guess it's probably no more than 5%, maybe even lower. So in aggregate, we're talking of sort of about 5%-ish of the portfolio, and 95% of the portfolio is in companies that are profitable on a sustainable ongoing basis and expected to make profits. Now, in terms of what metrics we look at, we try and keep things simple. So the two metrics that for me are the most important ones. The most important one is sales growth, but the second equally important one is operating profit margin. So we just try and keep things simple and focus on the OP margin, because the operating profit margin we feel is a much more reliable indicator because it has less one-offs, and it's quite difficult to fiddle around with an operating profit margin ratio. And it also gives you a sense of, at an operating level, how a company is performing really. So these are the two metrics that I keep an eye on.
Okay. We've got a question here around, to what extent does Shin Nippon support, advise, finance its investee companies?
It's a very, very interesting question. And I mean, this is something that I've done in the last kind of 6-7 years, where, my view, and again, it's probably quite different for different people, but my view has always been that, as a small cap manager, especially in a country like Japan, that's never really supported its small caps in, any shape or form, along with sort of investing for our shareholders and, trying to generate an attractive return over the long term. I almost feel that we also need to we can play a bit of a part in terms of shepherding some of these companies. And wherever I've got the opportunity, I've tried to engage with companies and give them some kind of very high level advice, not really trying to be activist or, telling them how to run their business, because that's not my place. But just to give you an example, one of the companies that I've engaged with in the past is a holding called Raxel. So it's an online printing business that also has a pretty fast growing advertising business as well. And this is a very young company, less than 10 years old. And in the past, they've asked me for advice on things like how should they think about the balance sheet given their stage of growth, Should they be issuing equity? Should they look at debt financing? Those types of high level questions. And also some of the engagements I've had with companies has been at a more strategic level in terms of, they will look, if a company is thinking of entering a particular area, how would we feel about that? Does it make sense for us? And one of the main reasons why we are able, or why I'm able to engage at such a high level, usually with the founders and presidents, is simply because when we invest in a company, we spend a lot of time doing fundamental research, talking to suppliers, vendors, various management teams, and trying to form as comprehensive a view. Obviously, you can't learn everything about a company. It's an ongoing process. And when we do invest over time, we end up taking quite a significant position in the company. So this company, Raxel, for example, we own about 9% of the company. So when you have a very supportive long-term shareholder with a big shareholding, it becomes easier for us to get access, and also companies listen to what we are saying. And whether they take it or leave it, that's up to them. But as someone looking at really up and coming businesses, I think that's a good opportunity for us to try and engage with them and sort of advise on certain matters where we might have a helpful view.
Okay. This person wants to get into the nitty-gritty. In the past 12 months, were there any investments which you deemed to be mistakes or are no longer invested?
So in the past 12 months, we have sold a few stocks. And again, they were a combination of, a loss of faith in management's ability to kind of grow the business or respond to competitive pressures. But also it's been a case of where the company has actually become quite successful, so much so that it's become a larger business now, and where the growth from this point onwards, we felt it's perhaps less exciting. So one example would be Japan's largest online advertising company called CyberAgent, which we invested when it was a small cap. And since then, it's been a phenomenal performer. It's become a large cap. And we're happy to run our winners. But in CyberAgent's specific case, we were not confident that the online advertising industry is going to grow at the same rate as it did in the last 5-10 years. We felt that CyberAgent has already become too big within the online advertising space, and growth from here onward is likely to be, a bit of a hard slog. We might be wrong, but that's the view that we kind of built, having, looked at recent results, spoken to management, etc. So it's usually those types of reasons why we end up selling a stock, where we lose faith in management, really.
Okay. We've got a broader question here that somebody would like a recap on portfolio, the portfolio in terms of its volume and nature. So if you could give us the bird's eye view of what our viewers should be categorizing the trust as.
Yeah. So, at a very high level, Shin Nippon is explicitly a high growth portfolio. If someone is looking at Shin Nippon as a way of diversifying risk, or as a steady kind of portfolio, this is probably the wrong portfolio for you. This is explicitly a growth focused portfolio, investing in the companies of tomorrow and not in the companies of yesterday. And at a very high level, at the moment, we have pretty close to 80 stocks. I think 79 stocks we can own up to 80 stocks. So we are at 79 at the moment. And the makeup of the portfolio is we have about a quarter of the portfolio roughly in what we call as the online disruptors. So these are companies that have been a favorite hunting ground over long periods of time, disruptive, fast-growing businesses across a number of sectors, but usually online-based business models. So again, quite young businesses. Then we have maybe another 30-35% of the portfolio in what we call as the niche manufacturers. And these are the companies that I've been talking about in terms of the global hidden champions. This big tank manufacturer, for instance, would be an example of a niche manufacturing company, although we don't yet own this stock. And these niche manufacturers, again, are spread across a number of sectors. So autos, industrials, factory automation, healthcare even. So that comprises about 30-35% of the portfolio. And the rest of the portfolio is made up of a combination of global brands. So companies like Descente, which is a very, very high-end clothing brand for skiing and golfing, and they have a very, very fast growing business in China. It's a very, very popular brand in China. Or Pigeon, which is again a very popular brand in China for baby bottles and accessories. So we have a few of such global brands. Yonex, another example, the world's leading badminton brand. We also have a few healthcare names, outsourcing and services. So a few staffing companies, given Japan's labor shortage. I think these companies should do really well in this kind of an environment, especially with wages going up as well. And we've got a few niche financials. So that's kind of the rough makeup of the portfolio. It's a very, very diversified portfolio. It's not exposed to a single area or a single type of company. We have very, very decent levels of diversification. But the one common thing that ties virtually every single stock is that these are businesses which we believe are likely to grow their sales or profits or both at a much, much higher pace than what the market thinks or than what you would get with a benchmark or an index, for instance. That's the common theme that ties all our holdings.
Okay, well, the questions keep on coming. So we've got a couple more, some more sort of technical ones now. One on the discount rate. So what discount rate are you using for valuing a typical company or portfolio? And secondly, are you seeing many opportunities within the private markets? And could you talk around the current private companies you own and how these deals are sourced? So a couple more technical questions there.
So the first one, I personally rarely do any discounted cash flows where you would use discount rates, and that's partly for the reason that discounted cash flows models can be very sensitive. And instead of that, and this is true perhaps across of Baillie Gifford, we try and do a lot more of scenario analysis where we, after our rigorous research, we kind of bring all of that together in trying to construct a base case scenario, which is like the bare minimum return that we would expect, a bull case scenario, which would be the more optimistic take, and a bear case scenario, which would be quite a pessimistic scenario. And in general, for every stock, before we make an investment, we would expect at least a doubling of the share price on a 5-year view in our base case scenario. So at a bare minimum, we would expect a doubling of the share price. If we are really struggling to build a scenario where we can see that happening, then that becomes less interesting for us from an investment point of view. A bull case scenario would be where we have a more optimistic outcome, where we're not talking of a 5 times or a 10 times return, but almost like a 20 times return. So what needs to happen for the share price to go up 20-fold in a 5 or a 10-year view? And a bear case scenario is where you take the most pessimistic assumption, plug it into sales, into profit margin, and see what comes out. Do you lose all of your money or do you lose 80% of your money? So that's kind of the bear case scenario. So we try and do a lot more of these types of scenario analysis rather than using models or using discount rates, because these things, the best one in the world, are a bit of a finger in the air stuff. You can plug in whatever discount rate you want and get whatever number you want. Instead of that, because we believe in more qualitative type research, we kind of spend a lot more time doing that and then filtering the key aspects of that into our valuation work. The second question in terms of private companies, so we've been looking at this market since 2017, and so far we've only made 4 investments, which perhaps gives you an idea of how underdeveloped the market is. So the 4 companies we own, the first one is Moneytree, which is the first company we invested in. It's an artificial intelligence company for the banking sector, so quite ahead of its time. We invested in that company in 2017. Potentially quite an exciting business, given AI seems to be coming to the fore. The next one we invested in is a company called Gojo, which is quite a unique company. There's nothing like it in Japan, small cap, large cap, or mid cap in the listed world. It's a microfinance holding company. It has stakes in a lot of smaller microfinance businesses across Asia, in India, in Sri Lanka, really frontier markets. So it's a way of getting access to some of the fastest growing regions in the world by investing in Japan. And it in itself operates as a holding company. So quite an interesting business. The third one is Spiber, which is, again, a synthetic biology company, quite different. No other business like it in Japan, at least. And they've basically studied how spiders make silk, what kind of proteins.
Oh, wow.
And they've used that knowledge, used some clever AI stuff, and they've built a technique where they can now basically, on an industrial scale, generate any material you want, whether it's fake cashmere or fake kind of leather or whatever, which actually is pretty close to the real thing.
Wow.
They're generating they're using the same proteins that
Real life Spider-Man.
exactly. And they've got a very large commercial grade plant in Thailand that's just started production. So they're focusing a lot on a lot of brands and these car interior manufacturers, for instance, all your leather seats and your fur coat and mink coats. You soon be wearing those without actually having to kill all those animals.
Yeah, I imagine the ESG potential on that is huge as well.
Exactly. So quite huge. And the most recent one we invested was a company called JE Plan, which was last year. So this is a company that's developed a very clever, environmentally friendly way of recycling plastic. And they're using the same methodology, same technology to try and recycle apparels. So really potentially interesting business with a global appeal. Off late, we've kind of not spent as much time looking at private companies simply because the opportunities within the listed space itself is so exciting and so significant. But we have been kind of, looking at names that are quite unique, similar to these 4 names that I mentioned. So that's kind of an ongoing process.
Okay, well, we're nearly out of time. So one last question. Did you get that lovely bonsai plant behind you from Japan?
No, I'm afraid this has been set up to look nice and sort of cheerful when we do webinars like this, but no, unfortunately not. But yeah, it was quite nice to get back to Japan sort of last year, first time, and this year there was, quite a noticeable difference. People, a lot more relaxed. A lot of the meetings in November when I went, all the management teams were wearing masks. This time, 9 out of 10 were without a mask. So there was kind of a noticeable kind of, relaxed feel to almost all of the meetings, I would say. So it's nice for things to get back to normal in Japan.
Yeah, I'm sure it's, from your perspective, managing the fund, it's nice to really kind of kick the tires, as they say in the investment community, and really kind of get a feel for what's going on in the ground. I imagine after such a long time, it must have been a really great trip.
Yeah, I think perhaps for me, the more exciting bit is just finding these new ideas, because the danger when things are not going well for you, the danger is you kind of, withdraw and start focusing on the wrong things. I think what we are trying to do is, keep things simple, focus on the things that we can control. Obviously, we can't control what the interest rates do, what the politicians do in the US or China, but focus on things that we can control and try and be consistent in our approach and continue doing what's actually worked for a very long period of time and not try and chop and change things simply because the environment has changed. And we're really playing the very long game here. So that's essentially, the parting message for me, I suppose.
Well, thank you very much for sharing all of your newly found insight, Praveen. It's been great talking to you. That's all we have time for. And thank you all very much.